JD, I'm excited about this one. We've got an activist in front of us, Gabriel from Sandon Capital. This is exciting for us because we comment on activist campaigns. I'm an aspiring activist myself, but you've got a lot of learning to do. But I'm glad that you've joined us while we're in Sydney to briefly maybe teach me some lessons about activism, and B, talk about your latest campaign at Karoon, because that's pretty punchy, pretty interesting. And I definitely have a lot of respect, appreciation for the campaigns where people are willing to put their face, their voice, to their points, as opposed to do it like we watched the Whitehaven campaign from Bell Rock Capital, and the Mike O'Meara is just like, who is this guy? You can't Google him, you can't find him, you can't get him on a podcast, there's no evidence of this guy, but he's running an activist campaign, voting against REM outcomes, which we were sort of supporting that sort of campaign, but who is this guy? So we're glad that you can join us and speak with your real voice and your real face, and appreciate that.
Cool. No, I'll do the old Clark Kent.
Gabriel, a point where I want to start the conversation is you starting the fund, and a lot of interviews we listen to sort of start that way, and they can be sometimes a bit boring, but I'm fascinated with the story because you started it, it's in the name, it's an activist fund. So what sort of stood out in Australia, perhaps, if that's the context you want to put it in, of like why you wanted to create an activist fund 15 odd years ago?
So putting activist in the name probably wasn't the smartest call. That's a starting point. So look, the reason I started the firm was that I'd seen situations where companies, so when you invest, you're taking a calculated risk. Sometimes the risk pays off and you make money, other times it doesn't. And sometimes you need to ask yourself, as I always did it work because I was clever, astute and made good decisions, or did I get lucky? Or did it not work because I made some mistakes in my analysis, or there were other things outside my control that affected my outcome? So those sort of simple quadrants was the framework that I always thought about. And there were times where I'd look at investments that hadn't gone the way I wanted them to go. And there were some that were purely my fault. Completely unforced errors. I shouldn't have made the investment, dumb choice, dumb analysis. But then there were some where it was like, hold on a minute, had they done things differently, the outcome for shareholders would have been different. So for me, that was the graduation, if you will, or the descent, depending on your point of view of activism, into doing activist investing. When I started the firm, I remember famous last words from one Jeff Wilson, when I sort of broached the idea with him, and he said, mate, that won't work in Australia. No one goes for that kind of stuff. And yet to me, the investment opportunities seem pretty clear. And frankly, despite the name and perceptions, low risk, because you're buying into things that are often already bombed out, and you're simply saying, well, this is why you got yourself into the mess you're in. If you do things differently, there could be a better outcome. So that's really the background to it.
It's funny you mentioned that, because in a bit of research, we did find a video of you and Jeff Wilson. It's 10 plus years old on YouTube, having a bit of a chat. Would it be right to sort
What
of...
company was it? RHG?
You were doing a collab. It was for a media company that doesn't exist anymore. It was the webinar kind of interface. Yeah.
Okay.
Yeah.
I can't
it's
remember,
funny because
but...
Jeff himself is now building a Twitter profile to have more of an activist voice. So, mate, you were right the whole time.
Jeff, I think Jeff met with Bill Ackman recently, and keen to emulate Bill's Twitter practice.
Yeah. So does it come from a real sort of school or philosophy of value investing? Is that the way you approached it?
Yeah. Look, look, we're value investors, so that's the basis.
Yeah.
And I think that activism is an extension of value investing. Value investing is the basis. Activism is one of the tools that you apply, and it's almost as though if you're not somehow, it's worth maybe going back a step. We always make the distinction between advocacy and activism, and one follows the other. One is the logical extension of the other. And I think most fund managers in Australia, active managers, are very good at advocacy. They'll go to briefings, they'll tell the company what they think, they'll thump the table and go, we think you. But for the most part, that's where it ends. I was sitting next to a well-known funds management grandee at a dinner the other night, and he said, I don't know why you waste your time doing what you do. we've looked at it, it's just too hard, we just sell out if we don't like it.
Yeah. Voting with your capital instead of...
Yeah, in America they call it the Wall Street Walk. You don't like what they're doing, get out. Even companies will say, you don't like what we're doing, why don't you sell out? From our perspective, if we see a value proposition that is attractive to us, we're not going to let go. So someone asked me one day, who's the greatest activist ever? And my response is simple, it's Warren Buffett. Despite all the cultivated persona of him being a supporter and all of those things, at his root, he's an activist. If you look at some of his earliest investments, they were clear activist investments. He also picked it up from his mentor and teacher, Ben Graham. Ben Graham was a famous activist in his day. So it's not like it's new. It goes through evolutions. I wrote an article a few years ago with a chap called Jeff Graham, who's an American, runs a hedge fund, and Jeff wrote a book called Dear Chairman, which was an anthology of what Jeff considered to be the best activist letters in America. And so he wrote chapters on letters by Ben Graham, Bill Ackman, Dan Loeb, even I think Ross Perot from memory. But basically he did an anthology, and so I got to know Jeff, and we wrote an article that compared the evolution of activism in the US to where we were and are in Australia, and just suggesting that given what happened in the US, there's no reason why it shouldn't evolve in a similar, slightly different way, but evolve to be a more prominent activity here.
So given some of the names you mentioned, Third Point Capital and Dan Loeb and Bill Ackman, these were really famous, but predominantly younger, in their funds management career, they went really hard at it. And Dan and Bill have both said in recent years they're taking a bit of a step back. It requires a lot of energy, a lot of tenacity, a lot of publicity to always fight that fight every day. Why do you think they've made the step back, and is there any lessons in that and how you approach it?
Well, in America, activism is typically a battle of who's the biggest gorilla. The way we describe it is, in America, activism is a really expensive pursuit. You have to spend millions and millions of dollars running campaigns. Trying to get votes is difficult because of the way custody becomes one of the biggest challenges in terms of getting votes. I mean, we've got similar issues here, but not yet as bad, but I can see it's getting to that point. The other thing is the field becomes crowded, but also a lot of companies these days are they're so scared and don't want to get involved in an activist campaign that for a lot of them, they just turn around and go, oh, you're on our register, tell us what you want, we'll do what you want, go away.
Don't drag our name through the mud.
To us, that is actually not good, because ultimately what we're doing and why we move from advocacy to activism is ultimately it's a contest of ideas. We want the ideas to be debated publicly. We want to put our case forward in a public manner and have other shareholders opine on it, because ultimately we're looking for a good outcome. We're looking for a good, thoughtful solution to the problem. Sometimes we might kick it off and the thing evolves and takes a life of its own. But if you at least have that tension, that contest of ideas, it's like the concept of equilibrium in physics. It's something that you aspire to get to, but you never actually reach, because the moment you get there, boom, it's moved to a different point. And it's the same with an activist campaign. I don't think you get the best results when you sit there thumping the table saying, I want. Mm-hmm. We see a much better result when you say, look, this is what we think you should do. What do you think? And actually have that debate amongst the shareholders.
I assume you'll have your thesis on how to unlock this latent value as you see it by pivoting strategy or changing incentives or whatnot. And my guess is, the first step is always have that conversation with the company and the board directly. What are the situations like where you actually decide to go public with the campaign as opposed to subsequent to that engagement?
Look, we've got our standard process and we follow it pretty consistently, and there's always exceptions to the rule. But broadly speaking, how it works is that we will write to a company to introduce ourselves, and that's usually our first contact with the company. we'll explain our position, usually include a pretty detailed presentation that analyses both problem and opportunity, problem and solution, or what we think the solution might be. And then the first step is, how does the company respond? So some companies will put their head in the sand, pretend we didn't write to them and ignore us and hope we go away. Not a good idea. Other companies will engage. That's good. Karoon, for example, we wrote to the chairman last week, still haven't had a response. That's fine. We've heard on a grapevine that they might be preparing a response, but even just the common courtesies of, hey, thanks for your letter, we'll respond to you in due course. So again, we've had other companies where we've sent the letter, and then the next we've heard of them is when we've heard stories that their investor relations people are out speaking to the market saying, oh, don't pay any attention to these guys. So again, how a company reacts to us is a test of how it's going to play out, but also what the company thinks of its shareholders.
It must be a pretty frustrating reality of the activist campaigns you embark on when a board essentially readies up to fight the campaign, and what do? They hire these proxy solicitation advisors with shareholder money to defend it, which as a shareholder must piss you off even more. So,
oh, look, it does. There's an interesting case of quite a few years ago where, and I've just right now I've forgotten all the details, but where Larry Adler, famous insurance father of Rodney Adler, wrote to Advance Bank in the day, and he was having a barney with them, and they were spending money defending themselves against him, and he basically wrote to them and said, hey, and I think he actually took them to court to say and establish the principle that directors can't use company money to defend their personal position. So there's always that balance. But look, generally speaking, the directors can do pretty much what they want with respect to a company. Ultimately, that's why for us, we're not so much focused on what the directors think or what the company thinks. Because look, typically, whatever we suggest, they're going to say, you say black, we say white. We say night, they'll say day. Companies don't like being told either that they're not doing the best they can do or that they should be doing something differently. And so for us, that's why we typically pivot to the activism, which is where we're lobbying other shareholders. And that's also the gate that we open about being public, because to have the discussions with other shareholders is much easier and more straightforward if you're discussing a public position, a publicly available document, so that you avoid creation of material non-public information. For a lot of institutional shareholders, that's a big, and understandably and rightly so, that's a big no-no. They don't want to have discussions with anyone that could give rise to any allegations that they had material non-public information.
Totally. Fuck, Matty, JD, these like activist stories, right? Like they often involve these, board members. There's some suspicions that they're not aligned with shareholders, and it rubs us the wrong way, rightfully so, right? And it's funny because these directors of companies have certain obligations, and it's a real responsibility. You've got to take these obligations seriously, because as a director, you can have personal liability. And that's why D&O insurance exists of all bloody things, because, never fear, that insurance exists, and it kind of shits me a little bit, but it does exist.
I know 3 blokes that could help you get that. We spoke about them the other day. Dave, Adam, Steve, CRE Insurance.
You are 100% right.
You have the solution for me.
Mate, should we really be helping
No, it feels a bit icky.
those sort of people?
It feels a bit icky.
Yeah, so I don't know if Dave.
Yeah.
Dave,
but good
Adam,
people need it
Steve.
too,
Yeah. So if you're a good person, that you're fighting the good fight, and you might have just found yourself in a prickly situation that is no fault of your own, mate. CRE, they love people like that. It aligns with their values. Fee for service, mate. I think they're just going to take over mining insurance.
Say the name for me one more time, Matty.
CRE Insurance. CRE is bloody
Australian owned.
K-Drill is drilling, CRE is insurance.
Loads of experience. Mate, act for some of the biggest miners. They're the best brokers. They're taking it over.
Yep.
No more Gemco. No more Capricorn. CRE.
They would still be there if CRE was.
Yeah, but the disasters wouldn't.
They would have got better advice.
Anyway, back to Gabriel. we should explore Karoon. I'm keen to to go there, given I think it was about a week ago, maybe a bit longer, where you kicked off this campaign, and it all started with just an ASX announcement showing that yourselves and Samuel Terry Asset Management, would jointly disclosing
we formed an association.
Yeah, formed an association for the purposes of voting a certain way at the AGM, which is coming up shortly. And with that, you basically outline what the collective the collective way that you're going to vote on certain resolutions at that AGM. When did you build the position in Karoon? Was it like you've been a shareholder since?
We've been there for a while.
Yeah.
We bought and sold, so it's been something on our watch list for some time.
Yeah.
Samuel Terry, we know, have been in and out of it as well. So again, you chat with people. But I think the AGM was a combination of the AGM and the acquisition and capital raising they did last year.
Which we've coined the worst executed capital raising of the year by Country Mile.
Is there an award? Do they get a little plaque? I'd encourage you if you want
to. It's horrendous. That's
the sort of thing.
And as a shareholder, you're like, that's permanent value destruction that you don't get back. That's
we should make a physical award.
No, but I was going to say that's the sort of thing that on a cheeky day I'd actually go down to the trophy shop and ask them to do a trophy, and I'd send it to the board and say, oh, by the way, here's our belated award for the worst capital raising of the year.
I'll give Karoon the benefit of the doubt. I mean, the bankers are probably to blame, and whoever the source of the leak.
No. Yeah. Say on that point, bankers will be bankers.
Right, you expect the worst.
No. Look, bankers are bankers. That's their job. Advisors advise, and so on and so forth. Ultimately, it's up to a board to say, thank you for your advice.
Yeah.
We're not going to do what you suggest. We've had situations. I've been in situations where, for example, our lawyers might advise a particular course of action. And they'll set out their reasons why, and I'll go, well, thanks for your advice, but we're doing this because commercially that's what we want to achieve. So I don't think it's fair to blame the bankers in a situation like that, because ultimately it's the board that makes the final call. We had a situation not long ago about another company that we know well where they were trying to get an acquisition together. Share price moved outside of the acceptable parameters, and they called me and said, look, really sorry, but we're not going to be able to proceed with that acquisition. No capital raising, no acquisition, because the share price means that it is not accretive to do. And I'm like, very disappointed, feel bad for you guys because you worked hard on it. Well done for making that call. That's the discipline that Karoon, in my mind, did not show when it came to who dat.
As a shareholder, you've probably watched a series and strategy unfold. I mean, they, like you articulated in your letter, there'd been some guidance in the notice of meetings in 2022, 2023 around potential dividends.
Yep.
And you might be holding it on the value investor case. Great, this looks cheap. Dividends, beautiful cash flow underpins it. And they acquire Hoodat, pretty dilutive equity raising. It leaks before they even go in trading, hold further value destruction on top of that. And there might have been incentives underlying all of that, which were poorly aligned in the first place. Do you kind of look at that, series of circumstances and almost see more opportunity as an activist? You're like, okay, there's latent value here because we can change incentive strategy, etc. So
if I take a step back to the framework, so as a value investor, we're looking for opportunity for a valuation discrepancy. We're looking for mispriced investments, something where we can perceive or see something in a company or an asset that is not reflected in the market price. The activism comes where you see that, but also, I don't know if you remember back to Venn diagrams in primary school. Yeah,
cast your mind back.
Yeah, cast your mind back. So I remember doing them thinking, I cannot imagine where I would ever use this once I leave primary school. Yeah. Well, whatever it is, 30 years later, 40 years later, I'm doing it now at work. But you got two Venn diagrams. You got the value proposition, buying an undervalued, mispriced asset, and then you've always got to make sure that there is a plausible path or opportunity to change the status quo, and it's where those two intersect. So we sometimes look at companies where the shareholders are clamouring for change, but we don't see the value. We don't find it's a big enough discount. Or other times we see a big discrepancy in valuation and price, but not an opportunity. So it's where the two intersect that we move. And the challenge is, the irony is that it's when investors are most dissatisfied and most scared that they're willing to change tack, change their mind. If you think to what most fund managers will talk about when they talk about what they consider to be a good investment, the words will be about stability, predictability, reliability, consistency. They're all words that imbue certainty. We're looking for the opposite. We want situations where people actually, shit, I'm really unhappy here. Or, for example, I've just been diluted in a capital raising. Then is when people are open to changing their minds. So for us, they go hand in glove.
I totally appreciate that. And then in the particular campaign that you've launched in this instance, you roll through the recommended ways that you want to vote. Kind of underpinning it is a vote against the re-election of certain directors, voting against the refreshing of placement capacity, voting against the adoption of a remuneration report, voting against some performance rights issued to the CEO. So, there was one word which you included in the one of the first paragraphs of your letter, which is, you're ultimately advocating for dividends instead of empire building. Yep. And empire building is this just your mind wanders with it, but were you fearful as a shareholder that there's some desire to empire build here by the existing board and management?
Oh, well, I don't think I don't think it's an unfounded fear. I mean, I thought I'd bring along some notes. I wasn't sure if it'd be, but I look at front page of the Karoon vision and strategy from their website, and they say they've got a list here of their strategy, and I won't read through all of it because it'll take up too much of your time. But at the end of the day, they want to seek value accretive producing close to production assets, leveraging Karoon's technical and commercial capabilities. And then they want to balance capital between high value growth and returns to shareholders. So on the one hand, you're right. They've said in previous notices of meeting in terms of how they want to grow shareholder value, that they want to consider, now that they've graduated from being an explorer to being big boys with producer pants on, they want to look at maybe paying dividends. That's disappeared. It's now euphemistically referred to as capital management, so it's nice and vague. To us, they've changed their tune, but also of all places, and I laughed when I read this, but of all places, in their sustainability report, they have a sentence that says that, and words to the effect, I haven't memorised the phrase, but words to the effect that says, we believe that growing our hydrocarbon resource is the best way to deliver shareholder value. Now, if that does not mean empire building, I don't know what does. Now, we're not saying don't do things, but pay some dividends. Dividends are, I think, aside from any other aspects, paying money out as a company forces discipline. It forces you to think that your capital is a scarce resource.
Yeah. And how do you sort of think about the financial acumen within the business? It's a sort of critique that I've heard of Karoon in the past, and there's a recent debt financing. Just
came through today, the details. So they've nailed it.
I mean, what do you think of the new debt coming on? The interest rates, it's not 2020 anymore. You have to pay on that.
So the news across the wires just before I came here was that they've secured it at 10.5%. It's a lot of money. That's 40 odd million bucks a year of interest. That comes straight of our cash flow. What the concern? So the new debt that they've raised is much less restrictive than the current debt they have. So arguably you could say that's a good thing. The challenge though is that given their stated objectives to build their resources, they've said that they're considering, in the past they've said they want to make acquisitions as well as explore. I mean, even in this year's notice of meeting, part of the justification for increasing the director fee pool is that they're looking to expand into other geographies. So suddenly all of these things are, it's almost like if it walks like a duck, talks like a duck and quacks like a duck, even if you don't have a photo of the duck, you've got to start thinking it's a duck in question. Whereas it feels as though they're telling us, even though you've got evidence that we're now cashed up, we've said we want to grow the resource, we've done this before, trust us, we're not going to do it again.
It's fascinating, right? Because you could have a defensible strategy saying we think we can buy assets priced at $65 long-term oil price, but in reality, we're pretty sure it's going to be $80, and we're the type of company that you own who's going to be aggressive M&A, and that's your identity. But they didn't communicate that. Like, they had this discussion of dividends, which is veered, and when you combine it with the calibration of incentives, I'm keen to get your unpacking of that, because both you and Samuel Terry Asset Management have done some work looking at the way the STIs and LTIs might have been incentivizing the wrong thing. This is one thing that frequently shits us when we talk about mostly mining companies is like A, really lowball incentives, and B, like incentives that vest, which encourage things that aren't aligned with shareholders. Okay, you had a flatline EBITDA hurdle, or cool, you acquire something and those vest at any price, like it can be value destructive. Like when you broke down the incentives at Karoon, what did you see?
Well, I mean, so in Bauna and now Hudat, they've got two producing assets. Yet, depending on how you attribute the STI incentives, it's anywhere between 20 and 45, even let's be generous, 50% of them are to do with optimizing and delivering on production. The rest were, 20% was for acquire a substantial second asset, full stop. Not acquire a substantial second asset that is accretive to shareholders or to the cash flow generation of the business. No, it's just acquire a second asset. That beggars belief. That's almost, that is akin to me as a hedge fund having a performance fee hurdle that says, just make an investment and we'll pay you a performance fee. God. I mean, it would be interesting to live in a world where that was acceptable, but it's not. So again, we wonder, what are they thinking when they're setting those criteria? At the end of the day, incentives are there to guide and encourage certain behaviours. They're important, they matter. And just on the issue of remuneration, I think one of the observations I would make is far too often the discussion of remuneration really boils down to just envy. You earn more than I do and it's not fair, I don't like it. That's not us. We're not about that. What we want to do is we want to make sure that whatever you ultimately walk away with is well earned and pales into insignificance compared to what your shareholders have made.
Yeah. The owners of the business.
Yeah.
Yeah. A topic that comes up pretty frequently with us are incentives. And I just want to round back to the sort of thesis behind the activist fund and picking opportunities, because it's obviously a whole lot more work to take on that activist bent, when the Venn diagram meets and actually go and pursue that opportunity. Does the reason you go and do it, because perhaps, if you were just looking for those value plays, there's just not, it rules out too many opportunities in the ASX in the market you look at, or you think it's an edge that you might have that's underserved in the Australian market?
Oh, look, I mean, time will tell. We're only 15 years into this exercise. So, was it Zhou Enlai, who was one of the leaders of the Communist Revolution? They asked him one day what he thought of the French Revolution, and he said, it's too soon to tell. So I guess we're in that same boat to a degree. Look, part of it is I seem to have certain skills in this exercise. I know a lot of other things I'm just no good at. So, I speak to other fund managers for whom I have an enormous amount of respect, and they'll tell me about how, they're trading this, they're doing this, and they're great at it. And I'm just like, it's gobbledygook to me. I don't get it. It's not our way of thinking. We're buying into businesses. We think of them as businesses, but we're also thinking of how can things be different? What can we do if the status quo were to change? What would our outcomes be? Sometimes it can be for example, a Karoon, change your incentives, change your capital management policy and reward shareholders a bit more now, and you should get more back in spades. Other times it's a case of you're pushing shit uphill, just give up, move on, sell all the assets, give the money back to shareholders. We've done that a few times as well. There's no single rule for every opportunity. With Karoon, why they wouldn't have as an STI, for example, or even the LTI would follow this STI. We think that if they had an STI criteria that said pay X percent back to shareholders in the form of dividends, set a payout ratio, I wouldn't mind if management gets rewards for that.
Totally.
Be deserved.
Totally.
It's not that we're saying we don't want you getting paid, we don't want you earning. We want you earning in a way that ties back clearly to shareholders. And it's not just about the risk, the upside, it's also about the downside.
You don't mind paying great remuneration when it's literally tied to performance.
Yep.
But if you get paid irrespective of performance, in fact, if you get underperformance and you have to pay, it's baffling as a shareholder to be in that position.
Well, with Fred and Samuel Terry, we happen to be shareholders in another company called Global Data Centres, where they'd had their own troubles post-IPO about trading at a massive discount to the stated net assets. And the solution there was, which Fred and we advocated for, was to change the incentives. So instead of paying the manager a percentage of assets and then some performance, there was a change of remuneration that was skewed towards realisation and returns to shareholders, which hopefully the manager will make enormous amounts of money from, but then so will we.
And in this situation with Karoon, there's a different view, you think, the board ultimately, that you need a different composition of board members?
Unless the current board are willing to consider changing what they do. So to go back to sort of, activism 101, one of the things about interacting with the board is really what you're trying to ascertain is, are any of you likely to be part of the solution, or are you just all part of the problem? And once you answer that question, you then know what the next step needs to be. And so if the board collectively are saying, hey, we're all of the same view and we're part of the problem, then you go, oh, okay, well then maybe I need to try and do something to change you. And sometimes changing the board can simply be bringing them to the edge, bringing them to the brink, and then they change their minds. I mean, there's nothing like changing your minds when the facts change. And if a board thinks that they no longer have the support of shareholders, often they change their minds too.
Yeah, these processes can go a long time, like the Iluka Deterra, relatively long time example. With Karoon, we're in the early innings. We've spoken with another fund manager out in Perth. He had a campaign with Carnarvon that lasted all of a day, and there were changes immediately. I'm interested to hear about the Deterra Iluka situation and how that played out, because 2016 is when you started that. 2020 is when we saw Deterra list. I've got to be frank, 2016 was a bit before my time, but I'm interested to hear how you sort of formed the position. And, when you're in the thick of it, 3-4 years is quite a long time. Were there sort of times where you were thinking about selling out the position?
So we say, and we mean it, we are a medium to long-term focused investor. So 3 to 4 years is a trifling amount of time. Where we first came up with Iluka was that, so Iluka is a mineral sands producer. So the problem with mineral sands and all the, I'll use mineral sands as the generic, but things like zircon, the rare earths now is a bit more of a focus, but none of these things are exchange traded commodities. So you can't look to see what the prices are. And the other thing that we've found over the years, but Iluka is a perfect example, is that markets tend to easily misprice companies when there aren't near or close comparators.
Totally.
I've heard the expression in mining called nearology.
Yeah, it's a great one.
We've got this, they've got that, we're near them, ergo we should be like them.
Often kicked around in West Perth.
Yeah, exactly. So with Iluka, we knew Iluka well. My colleague Campbell Morgan had spent a number of years working in the US, where you've got a lot of not just mineral sands producers, but all the upstream, downstream. So, for example, titanium dioxide is used as a whitener / opacifier in paints and ceramics. So, being across industrial products, you understand the importance of the mineral sands suite of products. What was interesting and what piqued our interest in Iluka was that Campbell actually came across an EPA report that suggested that BHP was looking to expand its Mining Area C project. So Mining Area C is basically the location of the main BHP iron ore hub in Western Australia. Mining Area C is arguably the preeminent iron ore asset anywhere in the world. And the royalty that Iluka owns has been known for years, but was never really valued much by anyone. So a few years back, quite a few years ago, BHP offered Iluka $10 million to buy the royalty.
Would have been the best deal of all time.
Well, there was another opportunity.
Yeah.
So, lightning sometimes strikes twice.
Yeah.
Iluka rightly said no.
Yeah.
No, thank you.
Yeah.
A few years later, as production was ramping up, BHP offered them, we're told, somewhere around the 75 million.
Yeah.
Iluka once again said no, thank goodness. But what we started doing was that we learned about this EPA stuff. So suddenly pulling threads, learn a bit more. And you realised that if BHP were to do this, the expansion into South Flank would have a multiples time effect on the royalty, the production out of the Mining Area C envelope, and therefore the royalty that would be paid to Iluka. At the same time, over the years, we'd developed an appreciation and understanding of royalties. Mm-hmm. Again, not a particularly well understood investment in Australia, partly because there are no comparators.
Yeah, totally. And we've got more forthcoming equity markets where royalty finance isn't as prevalent. And
correct.
Franco was a logical
royalty
consolidator.
finance occurs here,
Yeah.
but it's foreign capital into Australian projects that don't see the light of day in the eyes of Australian investors. And so we'd been a fan of royalties.
Yeah.
We'd studied them, we'd looked at them, we'd always said, gee, wouldn't it be great to get our hands on one? And then suddenly you see Iluka and it's completely mispriced. But what we also understood was that a royalty in terms of its capital profile is very different from a commodity business.
The discount rate is...
Not just the discount rate, but the requirement for capital.
Yeah.
Yeah.
So a traditional commodity company, if it wants to expand production, needs to spend money. Either upgrade the facility, basically they need to spend money to make money. The royalty, a good quality royalty, is basically just a contract that says you will get a percentage of everything that comes out of this pit. That's what we had there. So what we saw was a company where the mineral sands business is highly cyclical, very cyclical, capital intensive, and mineral sands mines tend to be very short-lived. On the one hand, it's good because they tend to be shallow resources. I mean, they're literally sand, so they just hoover them up. But it also means that they have short mine lives. Which means that the market is always thinking, oh, they've got this one, but where are they going to go to next? Whereas with the royalty, you've got this incredibly long-lived income stream, which doesn't require any further capital. And yes, gives you exposure to the iron ore price, but otherwise is a different capital profile. And so to us, it was a case of, oil and water, chalk and cheese, very different capital profiles. The company at one point was saying, but we get a benefit from it because when we're borrowing money, the banks see. Well, I could see the banks were getting a good deal because they were taking less risk, but the lowering of the risk was not reflected in the price that Iluka was paying. The other thing is a royalty lends itself to paying out all its free cash flow, whereas a capital-intensive business needs to retain some money. So
they might waste the money.
So from our perspective, it was one where these are very different businesses, even though they're ostensibly exposed to commodities, they're different businesses that should attract different investors. So we did the work, we went public, we went to speak to Iluka. they told us, oh, no, this, no one wants this. We've looked at it. We know best. There's no need to do this. That's when we went public. We ran the campaign. What probably worked against us more than anything else at the time was that the mineral sand cycle, we got lucky. Mineral sand cycle turned just as we were beginning our campaign, so the share price was going up. And when everything is moving in the right direction, it's really hard to get investors to change their minds or to want to do something different. They were going, like a lot of the investors, the institutional investors we were talking to were saying, yeah, it sounds plausible, but hey, what's the problem? I mean, the share price is going up.
Every activist campaign has a relative share price underperformance chart. You know,
Did the company appreciate the value of what they had when they pushed you back at that point?
Oh, I don't think anyone.
Yeah.
Certainly shareholders didn't. The company, you know, we were told that we were perhaps a bit bullish.
Did they know about the EPA stuff themselves at this point?
Yeah, of course. But say, for example, at the time we were being told, not just by the company but by others, oh, there's no certainty that the deal that the expansion will go ahead. BHP haven't made final investment decision. But to refer to my useful duck from before, when you've got all these things lining up, and the next step is final investment decision, there's no guarantee that the final investment decision is made, but the odds are it will head down that track if they've done all these other things. I mean, at one point we found there were press articles about engineering contracts that were being awarded. Awarding engineering contracts are they're lead indicators of how serious the work has been taken.
Now, Matty, you heard Gabriel mention this, you know, the EPA thing with BHP, and I was looking up BHP. How do they manage dust? I was curious, and there's all these like documents they put up of dust management. I found this one. It's a flyer. It's 4 pages. They tell you on this whole 17-step process, the word dust appears 43 times, and guess what, mate? You know what's not there? GetWet bladders. But guess what else?
Why?
It's bizarre. It's mental. And as a result, they get this. Look at this ABC article shaming them for dust in the houses of Newman.
You know why there's so many? You can't have both.
No.
You don't have a document that says get wet bladders and dust, because if you have the get wet bladders, you don't have the dust. So the reason dust is there so much, it's because they don't have the get wet bladders. Get the get wet bladders, you never even have to mention dust again. It is like that. Like, think of the risk triangle, fully eliminated by the use of get wet bladders.
But they do more than dust suppression, Matty.
Oh, mate, that is like the chopped chip of a cookie, mate. What else is in the cookie, Trav?
Firefighting storage, camp support, like potable water, construction work support, plant support, civil work support, alternate to turkey nests, emergency backup storage, mate. These bladders, like, they're more, and you can also, by the way, use them to sleep on like a goon bag pillow if you want to.
Mate, if you're into that. Mate, and you want to know the bloke you're dealing with at GetWet, Matt.hall. Every month he runs around a heap of smoked ribs and meat to all his valued clients and vendors. That is the sort of bloke you're dealing with here. That's in addition to completely eliminating dust from mine sites via a GetWet bladder solution. So,
Turnkey solution.
Turnkey, supply, install, the only ones that do it in Australia, the whole friggin' thing. Just GetWet Australia.
Back to Gabriel. Yeah.
So to us, everything was pointing in that direction, not reflected in the share price. Share price was going up. That was good, but at the same time bad. And so one of the other things that we found when we were doing that was that a lot of investors just didn't appreciate royalties.
Yeah.
So we decided, we've got to take a step back. Let's do a white paper. So we did a white paper just explaining royalties. Royalties 101. The irony is that as much as investors at the time did not appreciate royalties, some of Australia's great fortunes are based on royalties.
Lang Hancock.
Stan Perrin, the Bennett family. The list goes on. So,
heck, our tax.
So, to us, the ingredients were there. Share price was going up. Therefore, investors weren't really that. They didn't feel the need to push the company to do anything. And then, I think it was around 2019, the Sierra Rutile debacle really hit home. So Sierra Rutile was a company that had been acquired prior to Tom O'Leary's joining the company. So it's not Tom's, you can't hold him accountable for that. But Sierra Rutile just turned into a complete, cluster bomb. And suddenly all of the shareholders, or a lot of the shareholders that we'd previously been talking to about the demerger, suddenly the stock's being downgraded, everything, share price is falling, and suddenly people are calling saying, oh, that idea about spinning off the royalty, does that still make sense? Blow the dust off the presentation. Of course it does. It makes even more sense. And that's when there began to be widespread shareholder support for the demerger.
Yeah.
Because they were suffering pain on the core business. The share price was down. Suddenly it's like, oh, gee, we need to do something.
The ultimate demerger that eventuated was not one where, Iluka completely parted ways with the royalty.
No, they continued to hold
20%, I think.
15-20%. Sorry, I shouldn't remember
that.
But.
And so, it's kind of like, okay, in principle we agree, but we still actually really like this cash flow.
Yeah, they do.
And now they pass it through to their own shareholders.
They do. And I think at the time, part of it was look, I don't think that Iluka did that willingly. They were facing pressure from a number of their shareholders, the large ones. So we were small. We had about $5-6 million invested. Tiny investment. But the idea we had gained traction amongst a wide number of shareholders, and I know some of them were privately saying, "Guys, this is it. You're doing it." So I think the holding back of the stake was a way for the company to sort of give some shareholders what they wanted, but not let go completely. In time, I imagine that would go, but then you've got the question of, well, what about Deterra now? And I think Deterra is interesting in that I think it's built itself a cost base that is not sustainable.
Totally, it's like
10
12 million bucks a year, thereabouts in what? To get a check and pay it out?
Campbell and I magnanimously offered, not to the company, this is tongue in cheek, but we would magnanimously consider collecting the checks, checking the production numbers, and liaising with the registry to post and do direct credits to shareholders. We'd do it for $500,000 a year.
Yeah.
And that's two of us.
It's some great synergies there.
Yeah.
But of course, the pitch when they came to market was that we can build a royalty portfolio given great access to finance. We can do more deals, great cash flow, we can buy stuff.
In fairness to them, we actually thought that would be a good thing to do as well. So in our thesis about Deterra and what it could be was that you could build a world-class portfolio.
It's been 3 years and they haven't
What we've now realised is that with an asset like Mining Area C that is, it is irreplaceable, it is irrepeatable. It is actually Sophie's choice where you can't do any better than what you've already got.
No. Yeah, it's the same with Franco-Nevada in the States, and they bought the initial one that the whole company's founded on for, I think, $2 million. It's returned $1 billion plus, maybe multiple billions. It's like, how do you replicate that?
Yeah.
Franco should just buy Deterra. There might be some tax implications.
Franco-Nevada they like precious metals.
Yeah, they've got some iron ore in their portfolio though, and it's the best royalty in the world.
Look, maybe they do, but I think the challenge for Deterra is, and in the beginning when we were shareholders, we were like, we'll give you, we think you should try and build a portfolio. They've not been able to do anything. We also understand that, so we can appreciate why they haven't. Because we see also some royalties from time to time, and so we have an appreciation for how hard it is to get a good royalty at a fair price.
It's competitive, and a lot of royalty companies bid them up to the max.
Yeah. So I think, and look, we're not in Deterra anymore. We sold out a while back, but we might go back in at some point. But our thinking is that they're probably down the wrong path at the moment with this cost base that is there to consider all sorts of new royalties, but not actually do something. I think they might need to dampen down and tamper their ambitions and just say, look, we'll just do a good job at getting money back to our shareholders as cheaply and cost effectively as possible, because we can never do better than what we've already got.
If you do want to do an activist campaign there, we'd be more than happy to have you on the show again to announce that one. We appreciate you making the time. Very generous. It was great to hear about the sort of philosophy and the campaigns you've done.
And best of luck with Karoon. We're in your court.
Thank you. Appreciate it too.
Hey, can you ask Fred to come on the show? Bloody hell.
I did. He politely declined.
Damn it. I'll keep trying.
Good on you, boys. How good this little sub out thing going? We get a bit of GC in one episode, bit of no Matty, a bit of Matty.
When one of us needs a nap, we just
You're an impact player, mate.
I'm an impact player. I'm no good playing 80 minutes. I'm better off the bench.
All right, we've got a couple partners to thank.
Mate, in the show, we have the great insurance brokers, CRE.
We also had GetWet Solutions. Give Matt.hall a call or email.
And you might get some beef short ribs.
Yeah, you will.
Yeah. Who else we got, JD? We got
VRIFY.
K-Drill, Brooks Airways, DSI Underground, WA Waterboards. Oh, how good are they? Look
No further.
and mate, last. We're mixing up the last. It's always K-Drill, but today it's Silverstone.
Go Australia.
Go Australia.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.